Testing one, two, three. Can everybody hear me okay?
Got you loud and clear, Tom.
Oh, great, 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 great. Is Lewis here yet?
I'm here.
Hey, Lewis.
What's up, Tom?
Long time, long time.
For sure.
Yeah, and what we're going to do, I got a couple questions, just general questions I wanted to ask Lewis, but then I think it works out better for everybody here is for him just to sort of tell his story and all that. But I know a lot of y'all read about it, and when they, everybody, it's so funny about this industry. Everybody becomes a legend, I guess, if you last more than 3 years. Okay, but you're really very fortunate to have Lewis here because Lewis is really a legend at the time, that he was in the pit, uh, far and wide, still to this day, people know that at one point, I think you had about 10% of all the volume traded on the S&P, if I remember correctly. It's just huge amounts. But if you will, sort of given your background and I guess sort of how you got into this game of trading, Lewis.
Yeah. Thanks, Tom. Oh, so it's kind of ironic the way I've got into trading. I actually was going to go to law school. Graduated from DePaul University in Greencastle, Indiana. I was going to go to law school, and then 2 days after I graduated college, my dad passed away. Um, well, people do the background. I mean, my dad was murdered, and he was involved in organized crime. And so I ended up going, I ended up driving a truck for about 6 months. My dad had a small trucking company, and I was driving a truck and I was looking at gold futures. Now, this is, I graduated college in May of 79, and gold was like at $850 an ounce at that time. And so I was at a local YMCA. I was playing handball with the guy, and I said, I'd like to open an account and trade gold futures. And he said, Lewis, don't open up an account. Why don't you come down and take a look at the mercantile exchange and see how you like it? So I went down to the mercantile exchange, walked through the doors, and the minute I walked through those doors and I saw and felt the energy that came off that floor, I just said, what is this place? And I got to figure it out. And that was in 1980. And I took a job as a runner making $137 a week. And if people don't understand what a runner is, the way the Mercantile Exchange and the Board of Trade were organized, where there were all these phone booths, and then there was different pits, like there was pork bellies, cattle, gold, um, euro dollars. Well, no, euro dollars weren't open when I first got there. All the foreign currencies, D-marks, yen, um, uh, D-marks, yen was British pound, and so on. So um, I got a job being a runner, and so what would happen is that the orders would go to the phone desk, and then the phone clerk would give it to me, and then I would take it to literally to the pit. So if it was the D-mark pit, I would run it to the D-mark pit, and that had either a buy or sell with a price, either at the market or with a price, either buy price or a sell price, or it could have been a buy stop or a sell stop. And fortunate for me, my mother was a legal secretary to two gentlemen that ended up being icons. Well, actually, it ended up being three gentlemen that ended up being icons in the whole um, trading industry, especially in the futures industry. The first one was Maury Kravitz. So Maury Kravitz was literally, um, he was a personal injury lawyer. His partner was Leo Malamed, who ended up becoming the president of the exchange. And then they hired a guy right out of Notre Dame by the name of Jack Sander. So, and Jack became the chairman of the CME. So, but Maury at one time was the number one authority in the world on two things. One, he was the authority on gold, and at the end of his life was the authority on Genghis Khan, and where Genghis Khan's fortune was buried. If we get time, I can tell you about that. So I went and I tapped Maury on the shoulder the first week I was there with a gold order, and he goes, and he was we used to call him his badge was ZZZ because he used to fall asleep when he was talking to you because he was like 5'2" by 5'2", right? So he was overweight. He had a thing called Pinkerton's disease, which his heart would slow to the point where he would fall asleep when he was talking to you. So I touched him on the shoulder, and he had this raspy voice from yelling and screaming. And he said, "Hey, kid, what are you doing here?" I said, "Maury, I was going to go to law school, but I'm thinking maybe I could come here." He goes, "Come back in 2 weeks. I'll have a job for you." And literally, that was the launch of my career. I went back in 2 weeks. He gave me a job being his clerk. And then after that, about a year later, I got a seat and was trading gold futures. And then I think 1984 or 83, the S&P 500 pit opened up. And Maury was thinking about retiring. And I said, "Maury, let's build a deck in the S&P pit." So we went back and got all our gold clients, like clients like Merrill Lynch, Goldman Sachs, EF Hutton, Smith Barney, Shearson. And we went into the S&P pit. And lo and behold, after about 2 years of struggling to get the volume up, the market got crazy. And I was ended up being about 10% of the volume from what I traded and from what I filled. So that's a pretty abbreviated story. There were a lot of bumps in the road until then, but it was an interesting time for sure.
Well, one of the things that intrigued me was the 87 crash. I told you I just got massacred, right, in 87. And you had a totally opposite story from 87. And you had a very interesting story. So share that with everybody, if you will, your 87. What kills me, Lou, today they talk like it's a correction, but it was not a correction, was it? It was crazy.
Yeah, so you think about the 87 crash, think about the Dow was at like 3,500, and in 3 days it lost 50%. So think about, by Wednesday or Thursday this week, if the Dow goes from 40,000 to 20,000, how many people are jumping out the window, right? Think about I think the S&Ps were like at 1,500 at the time, and they lost about almost 50% of their value in 2 days. And then the Nasdaq was the same thing. So it was funny because I was on my way to Europe on that Friday afternoon before Black Monday, and I was going to Europe for the first time. I was going around, hanging around with a bunch of guys that had some money. They were a little older than me, and they said, "Come on, let's just go to Europe, and we'll show you Italy and Switzerland and so on." So I had left that Friday afternoon, short 20 contracts S&Ps. And by the time I got to the airport, I had made like 250,000 because they had locked limit down.
These
So
were the big S&Ps, folks, not the little E-mini or the micros
yeah,
we're trading today. These are the big S&Ps.
we didn't even have e-minis back then.
Yeah,
So
exactly.
so then uh, went back, and because I had to get a hold of my clerks and the clerk on the floor, and she said, "You're up 200,000." I go, "Get me out. Make sure you get me out. I think the market's going to bounce on Monday. I don't want to have a position." And so then that Monday afternoon, while I was in Lugano, Switzerland, I was sitting in Piaget looking to buy a watch, and I looked outside on the ticker tape. Was I think on the Swiss, might have been Credit Suisse building, and it says Dow down 500 points. And I looked at the clerk and said, "There's got to be a mistake. It says the Dow's down 500 points." And you got to remember, 1987. If the Dow moved 20 points or 25 points, it was a big deal.
Right.
And I was in the pit when the Dow went through 1,000. It said for the first time, right? And that was gigantic news. The S&P or the Dow Industrial Average stayed in a 20-point range for probably stayed in there from 800 to 1,000 for almost 20 years before it finally broke out, right? So that Monday, I look at it and then I go back to my hotel room, and there's my my message board is lit up on my phone. It was my wife and my brother saying, "You better get back. This place is melting." My brother said, "I made $1 million today," and I was probably 5 times the size trader that he was at that time. And then so I had to try to get back. And so um, there were no direct flights. So what I did was I called British Airlines, saw that the Concorde, I could get on Concorde. So I left Tuesday morning for London and then got there about 11 o'clock. And then I took the Concorde back to New York and then New York to Chicago. And I walked on the trading floor Tuesday afternoon about 1 o'clock. And it looked like devastation. I mean, literally half the people were pulled out of the pit because they lost money. The other half, the other percentage of people were pulled out because clearing firms didn't want the exposure to people trading. People that were filling orders, literally. Excuse me, guys. I'm sorry. So literally, I had to, I'm navigating what's going on here, but the clearing firms didn't want the risk, and then people that were filling orders, they literally were putting their decks down, which is the paper orders that they filled for other for clients like Goldman Sachs and Merrill and so on. They were making $2 a contract, but they had the exposure for an out trade, and an out trade is you and I are trading in the pit together, and you think I traded with you, and I really traded with the guy next to you. So you could be out to buy, you could be out to sell, and if you're out, and the next day the market um, is opposite of your position. So let's say you thought you bought 20 contracts at you know at 20 and um I bought I'm sorry. I thought I bought 20 contracts at 20 from Tom, who was standing across the pit, and he really traded with the guy next to me. The next day, I'm out to buy 20 at 20 from Tom, and the market's, two, three, four, 500, 600 points higher. Now I've got what they call a losing out trade, right? So those were, you know, they're nice when you're filling orders and you're making $2 a contract and you're filling 5,000 contracts a day. You're making 10,000 a day filling orders, but one mistake could be 100, 200, 300,000. We had a couple of mistakes that were, over $1 million. So it was a different time, different era, very exciting. Commodities went from being a good old boy game to into the mainstream with the advent of financial futures. What I'm talking about, we had gold, and then they came out with the euro dollars. Then you had all we had already had the foreign currencies. Then they had the T-bills. Then came the 30-year notes, and then all those, we became in the premier futures was traded in the city of Chicago for sure. Just think that we got the S&P contract and um, all the big stock traders and hedge fund and portfolio managers were in New York, and the CME won that S&P 500 contract. So we were known um, for the commodities game, and New York was known um, for the stocks and then NYSE and the Nasdaq and so on. They had the Comex and the knife was located there, but our volume always surpassed theirs.
Luke,
Oh wait, so I didn't. So when I got on the plane coming back
yeah,
from Switzerland, um, I walked on the floor that Tuesday afternoon, and I made about 250,000. And then that Wednesday, same thing. I made another 200,000. And then Thursday morning was the famous trade that's in a lot of books and a lot of people talk about. Um, I walk in the pit, and the Shearson broker was looking at me, and he said, "Lewis, what's going on? What are you doing?" "Well, this is pre-market opening." And I go, "I don't know. What are you doing?" He goes, "I'm a seller." I go, "Okay, how much lower?" He goes, "I'm 1,000 lower." And this is before there were circuit breakers. So I go, "I'm 2,000 lower." He goes, "Well, I'm 3,000 lower." I go, "Well, I'm 4,000 lower." And on the ring of the bell, he goes, "I'm 5,000 lower." He went to sell the market 5,000 lower. I went tried to buy them, but I got tackled by the guy behind me. He said, "I'll sell you 350." I go, "Where?" He goes, "I don't care. At the low, I'll sell them to you." So I buy the 350. I turn around and I get 350 contracts back then. You're talking about $75,000 a tick on the big contracts. So I'm looking there and the market's not moving in ticks. It's not moving like 05, 10, 15, 20, 25. It's moving in hundreds and 200 points. So it's going, 2100, 2200, 2500, 2800. So I turn around and I look at the other side of the pit. The guy goes, "What are you doing?" I go, "I'm a seller." He goes, "I'm a buyer." He goes, "I'll buy 300." I sold him 300. Where at? I gave him a price, and I gave my cards to my clerk. I said, "Go figure out where I'm at." And came back in about 15 minutes or 12 minutes and said, "I think you're up $1.4 million." And I go, "1.4 million?" He goes, "Yeah." So I made like about 1.4 million in 13 seconds. I walked out of the pit, went into the washroom, and started getting the dry heaves because I started thinking if that would have went the other way around, I would have lost everything I worked for. But it didn't work out that way. It worked out in my favor. So it was a very interesting time, 1987, the crash, and then there was everyone pointing the fingers. What caused the crash? Was it circuit breakers? Was it uh, the hedge that the cash portfolio people were doing? So uh, it was a interesting time, that's for sure.
Lewis, you go look at the pit, and you had all those guys in there trading. They didn't have charts, did they? They had what they had. They had numbers, right? And
We had
and
charts.
how did you do it?
So the way I did it, um, as I got more sophisticated, it was funny because as an order filler, and for most people don't understand what an order deck looks like, right? So if you're looking at a dome, you can see the orders going up and down, and you can see how many volume in each one. And those are, they could be retail, they could be some, there's a lot of spoofing that goes on today with the electronic domes. But um, the way we would organize a deck was that, let's say you're filling for 10 different houses, right? Merrill, Solomon, Goldman, like I said, Smith Barney, all these different houses, they would send their deck before the market opening. And in any order that was a buy that was below the market or a sell stop below the market went on the downside of the deck. And then on the upside of the deck went the sells and the buy stops. So then we had a clerk that would organize the deck in our hands so that as the market moved in either direction, we could execute the orders, right? So that's what a deck looked like, and that's how we organized the deck, right? So and they could be, like two, three, four, 500 points. But what I really found interesting at the time was um, I would have a bunch of orders coming at a certain price, like within 50 cents of each other, and it'd be like from 7 different houses, and I'm like, why do all these people have their price orders here? Why do they have these buys here? Why do they have their sells here? Why do they have the buy stops where they're at? Why do they have the sell stops where they're at? So that got me interested in technical analysis. So that was my first introduction to technical analysis. And one of the things I did was me and another guy hooked up with a guy who was a big GAN guy. And so we started, doing the GAN angles and GAN trading and things like that. And then so as I progressed and became a bigger trader, I would hire 3 different people. I hired 3 different people that literally would do charting for me. One was a reversal, um, making looking for market reversals. One guy was a true just buy support on down. I'm sorry, buy support, sell support. Another guy was a timing guy, right? And I'd have them come in and talk to me independently of each other, try to get some consensus out of the 3 of them. I would take the numbers and then I would use that to watch what was going on in the pit and watch for the institutional people to kind of fulfill what was going on in the technical analysis, right? Because excuse me, when we were in the pit, we were there just to make liquidity for the institutional orders, right? So, you know, sometimes you get an order by 1,000, it would throw the market out of equilibrium, right? So if the market was trading in a 50-point range and then somebody came in and bought 1,000 S&Ps, now I'm talking bigs, and it now went to a 75-point range, people would fade that move, thinking to go back to equilibrium. They would short against that order, and then try to get out and make little bit of profits, right? So on the floor, sort of like if you guys are day trading now and scalping, you try to make little trades, take little profits, and then by the end of the day, if you made successful trades, you have a nice profit for the day. So that's literally the way I got interested in technical analysis. And then when I started backing traders, then we had about, at one time I had like 13 traders I was backing, and then we would sit together and the same thing. The analysts would come in, give us their opinions. Everybody would have their opinion about what's going on and where they're at. We'd have their rules about how big you can trade, where the stop losses are going to be, and that's how we kind of ran things for about 10 years.
Yeah, and I think that what he's saying, and the way I would interpret what he's saying, and you tell me if this is right, he had a plan though. He just didn't go there and say, hey, I'm going to buy this or sell this. He had a plan, and having a plan is the first step for becoming successful, because you've got to have sort of I guess, what you're going to do when things are going your way, what you're going to do when things are not going your way. And I know that, it just seems like I tell people sometimes, sometimes you can't buy a trade. Other times they just come to you right and left. It's a cycle, and you learn yourself,
Yeah. So
right?
Tom, we used to call that ready, aim, fire, right?
Yeah.
Ready was the research. Okay. Aim was, hey, I'm going to be a seller at this point or a buyer at this point. All right. And then fire, we'd execute. And then when you executed the trade, then you had to put your stop loss in where you're going to be at. And then it's managing that position, right? Sometimes if the position went your way and you could see the market going to the direction that you thought it was and getting to the technical points you were, you might have added to that position, right? But the important thing was that we always had what was called ready, aim, fire, and then there was a stop loss, right? So it wasn't, I mean, sometimes nothing worked. So what you could have taken your trading card and said, buy, sell, throw it up in the ground, throw it up in the air. If it landed on a sell, you sell. If it landed on a buy, you buy. Now, I don't recommend to do that because it doesn't work that much, but that was the joke, right? But
Right.
and here's the other thing. One of the rules that I looked at, and this is probably true of anybody's been in um, business, starting their own business, or even successful at what they do. Um, you have to understand that the thing that's hard about trading is that you got to be trading for success, meaning you got to be trading a process. And if the process is correct, the byproduct is money. But what you're really trying to do is come up with a process that's you can repeat over and over and over. And then you can change the process, occasionally you can alter it, but you have to stick to that process. And what happens is that if you get a successful process and you make several trades, the byproduct will be money at the end of it. The problem is because there's money involved, it will definitely skew your process, especially if you have two or three losing trades in a row, especially if you lost more money. You know, it's funny. I just went through this. I got a son who's 38. He's done really well in the real estate market. He said, Dad, I'm going to try trading for a while. So he started charting and trading and so on and so forth. And so I gave him all my rules, and he broke every one of them. So he's not trading anymore.
He's not trading anymore.
No, he's
Well,
not.
I want to
But
say that I got a few more questions, because I do want you to share some of those rules that maybe will
yeah,
help them, and help me and help anybody that wants to listen. But you look at those times, okay, and now you look at the current information flow. And one of the questions that somebody asked was, how do you handle all the information coming at you? Okay, because you can get overwhelmed, right?
Yeah, so you got to remember, in the 80s, there was no internet. There was no what we call the democratization of information. One of the things that we were worried about, those mistakes that we had, there was no 24/7 trading. So if you were out and out trade and something like 9/11 happened, you had a problem. And you were out, let's say you were out to sell 20 um, at the high end, and I mean 9/11 came, the market locked limit down for 5 days in a row before it traded. So if you were out sells at the top, that was $1 million loser for you, right? So
Right.
back then, the information that we got was, it was probably more simple because all of the trades came to the floor of the exchange. There was no electronic market. There was no e-minis. There was nothing. All the pure information came to the floor of the exchange. So if you were good at number one, reading body language, number two, looking at the order flows that were coming into the pit, okay, and being very aggressive and astute, watching the order flow, like all the buys that were coming or all the sells that were coming in. If you could get in front of that order flow, you can make a good living down on the floor. There were a lot of guys that really never had an opinion. They just went in there, they stood next to a big order filler, and when things got people were buying, they tried to buy in front of them. When people were selling, they tried to sell in front of them. Much like and exactly like the high frequency traders today. So
Mhm.
they're just picking off retail order flow. You get you get these dark pools and so on. So it was exactly that. We were like the first high frequency traders because what we did was try to get in front of the basically the institutional order flow.
Yeah, I know that it's like you said, the process, everybody's got to have a process that works for them. You can take and copy somebody else's process, but it's got to fit, it's got to fit for them and work. And like you said, the byproduct is you got more money at the end of the journey. But give them, if you will, some of your rules, just basic rules. If you were, if you were out there and you say, hey, this is what you don't want to do, or this is what you might want to do or consider. This is
Yes,
where the real
yeah,
value, I think, is.
so it was funny because or ironic. Um, I used to have guys who wanted to, when after 1987, I got written up in USA Today. I became a pretty famous trader. Then in the mid 90s, I was on CNBC and Bloomberg. I was always having people who would contact me and say, you know, when I go to Las Vegas and I'm up with their money, I know how to lay it in and I jump on it. And I said, yeah, well, that's good. You're not going to make it down here, right? Because people thought that, because they were a good gambler. Trading's not about gambling. Trading's about playing percentages. And if you can't play a percentage and understand that you should be looking to, when you put a winning trade on, you should be looking to make $3. I'm just giving you a ratio, right? And on your losing trades, you should only be losing $1, right? If you do that, okay, and you make 10 trades, you could be wrong 7 times and still be up money if you stay to that 3-to-1 ratio, right? So, but it becomes hard. You know why? Because people put on trades, they put their stops in, they get stopped out, and then the market turns around and goes the other way, and they knew they were right, and then so on. So I tell people all the time, if you got to love your losers like you love your winners, because the losers are going to teach you more about what's going on in the market than the winners, right? I wrote 10, I call them the commandments, rules of trading. These 10 rules are still in effect today. Everybody I see who writes new rules, they're all a version of the rule I wrote back in the mid 90s, right? And the other one thing you really got to know is you got to know yourself. What can you accept when it comes to risk, right? Why is trading so difficult? And the reason trading is so difficult is there are two things that you can't chart. You can't charge fear and you can't chart greed. And everybody has different amount of fear and greed, right? And so you got to know yourself. You got to know what you're comfortable with. Like if you're an e-mini trader and you're trading one lots and two lots and you're consistent making money, and then all of a sudden you try to trade a five lot, and all of a sudden you're losing money, it's because you can't, you're not capable at this point in your trading career to step up the risk. So if you go to step up the risk, right, and now it makes you uncomfortable, it's going to cloud your judgment. So one of my rules was basically you have to know yourself. You got to know what you're comfortable with, right? What's going to cloud your judgment, right? And you know, it's hard because if you're going to do this game, it's not something you can do part time. It's something you have to do full time. You can't do it part time. I know someone said, "Could I share all the rules?" I don't even know if I tried to find them all before the meeting, but of course, the number one rule is you have to be disciplined. When I was looking for traders to back, yes, they're in the book. They're in my 1987 book. There's a bunch of articles out there. Like if you just Google me, Louis Borsellino 10 rules of trading, you'll find them. But um, so when I was looking to back traders, it was funny. I would have guys that were Harvard MBAs come to me and say, this is what I think of the market, this and so on and so forth. And I was very hesitant to look at guys that were so cerebral, right? And they had really concrete opinions about the market. I was looking for guys that were Division One, and well, at the time there really weren't any women trying to trade in the pits. The exchange it was physically impossible. There were only maybe a handful of women at the time. But I was looking for ex-athletes. I was looking for people that were D1 athletes, played college sports, um, and went to school because those people understood discipline. They understood how to discipline their mind and their body. So when you get into the trading regimen and you got ready, aim, fire, and you got to be disciplined, they understand that. They understand that being disciplined is the only way, and being repetitive, rinse, repeat is the only way that you can be profitable at that. So, because at the end of the day, the cerebral part of trading is all your research. After that becomes your experiences. So, we used to have this rhetorical argument all the time between people that were doing computerized trading, right? And I used to look at them and say, okay, so I'm a discretionary trader. I take all the information, I make the trades internally, and then I go make the trade. And then the other guys go, no, we're computer traders, and the computer would spit out the best trades until they had five losing trades in a row. Then they were optimizing, right? So, you got to find something that works for you. Could be a combination of um, you could be a point and figure charter. You could do market research. You could be doing put everything. You could be looking for moving averages, whatever it is. You trade for success, not money. Someone just put that in there. That was one of my big rules, right? At the end of the day, I used to trade for success. It was a competition between me and the markets, me and the other guys in the pit, me and the people outside of the pit. So those were the things that I looked at. And at the end of the day, if I stayed with my discipline and made, on a busy day, I would make maybe 2,000 trades a day, you know, and I'd turn around and then look around and I had, 15,000 in profit or 10,000 in profit. Now, being a member, I also had the benefits of very low commissions, very low commissions. So it was easy. From the retail point of view, you gotta take all that stuff. Yeah, there's another one. Lose your ego.
Yeah, I think that one of the things that I've always tried to encourage people to do is learn. Even I tell people if you can't if you don't like trading futures, learn about futures. And a lot of people, with the bad, I guess they had better marketing over on the stock side, right? Okay, they lure people into the stock market, and people hadn't figured out that if the S&P is going up, 75% of the stocks are going to go up. So I always encourage people to learn about futures, and I think you'd agree with me. The futures market is really, I think, a fairer game. Personally, I think so. How do you feel about that?
You it depends what you're, I mean, if you're trading, stocks are more of a, well, we know that, futures are a zero sum game, right? For
Right.
every winner, there's a loser, right? And where stocks are not, right? So, um, stocks, if you're trading stocks, like for example, I can give you an example last, was it 2 weeks ago? The Nasdaq was down 20% and then turn around. It was down, I'm sorry, it was down 15% and then turn around and finished up 15% on the day. I think it was the tariff day. Um, you know, I've been, and this is my personal thing. I've been buying a lot of the QQQs and the SPY, a couple of stocks I like at these prices. I like Tesla, I like Nvidia, things like that. Those trades that I'm putting on are not short-term trades. Those are going to be a 2 to 3 year trade, and I'm putting on a position because um, I'm betting on the new market economy. I'm betting on the tariffs being successful. I'm betting on Trump's policies being successful, and so I'm taking a more longer-term position. But I don't have time based on what I do now. I own a cybersecurity company, so I don't have time to do the research on which companies I want to buy. So I want exposure to the market, so I just keep buying the ETFs, the QQQs, and the spiders. So
Gotcha.
and
Yeah.
that's I understand that because that's what I was brought up in, right? And
Right.
I was listening to all the talking heads today, right? Um, you know, when I first started writing down on my S&P cards, I was writing 95. That was the average. So look, we're in a 150-year bull market. If you're going to be trading stocks, you need to just sit back and and just play the long game, right? It's kind of hard to scalp stocks because I was in that game too. I don't know if most of your people know. I actually started the first Nasdaq stock trading room in Chicago called the Chicago Trading and Arbitrage, which actually morphed into Archipelago, which became the New York Stock Exchange order entry system. So I watched the people that were day trading stocks when they were day trading what they called the SOS bandits, and it was the same game. It was the same game. They were, trying to at that time they were making eights. It was before decimals, right? This is in 1996.
Right.
So people day trading the Nasdaq stocks, and it was funny because that whole year I used to call everybody wanted to be like Mike. Everyone wanted to be like Michael Jordan, right? And they would all come in, you know, with money, but didn't do the proper educational background. They didn't, everybody wants to get in there and start trading right away, right? And um, it's funny because a lot of people, to trade on domes and trade on, hypothetical money, right? And I've never seen a guy trading on the domes on the hypothetical money, or what do we call it? What's the word?
Fake money.
What's that?
Simulator.
Yeah, simulator, right?
That's it.
I've never seen
Simulator.
anybody. I've never seen anybody lose money on a simulator.
They're
Never.
all great.
They're all great. Everybody makes money on a simulator, right? And then
Yeah,
they
that's
jump
right.
in, right? And then they jump in, and when their real money's on the line, their brains get twisted. And then when they're looking at losses, right? So it's not easy. Remember, you're a retail trader. You're trading against hedge funds, institutional traders that have long-term opinions. You're having you're getting people that are experts at shorting the market and things like that. So you got to be on your
And
game.
different segments of the process, specialists on different segments of it. So,
Yeah.
Lewis, let's see if there's any questions anybody has that they'd just like to ask. I'm sure he'd be glad to answer if somebody got questions that we didn't cover. And I really do appreciate you taking time doing this. I know he's running the company. He started with 2 employees, folks. It's up to over 100 now, and it's growing. But he's using a good process in that company. It's paying off. Probably some of the same things he learned as a trader years ago, or paying him today. But anybody got any questions at all that'd like to ask Lewis?
That's like, who's that? Paulie Z? Paulie.
Yeah.
You know what they say about selling options, right? It's picking up nickels before a steamroller. So Carol, I don't have I have two sons that work for a big ETF shop. I don't want to mention their name right now, but yeah, I think there's some ETF dividends plays that are good, right? The return, I don't look at those right now because I just want overall market exposure. But there's different strategies with ETFs for sure. The big game right now is the covered call game, right? Hey Tom, that's a good question, right? Because yeah, that's a good question because that was one of the things that we would look at all the time, money flows. Are they jumping out of are they jumping out of you know the NASDAQ, our flight to quality. Our flight to quality used to be out of equities into bonds, but there's a whole generation that grew up with 0% interest rates. When I first started trading, interest rates were 19%. I bought my first house and paid 19% interest rates. And I tell my kids, my two sons, all the time, they grew up, they're what, 31 and 34. They grew up with all the 0% interest rate, quantitative easing. They grew up in all these things, and they're moaning about, bitching about, complaining that interest rates are, 3%, right? And I look at this in, get a lot of questions here. Market depreciation. I'm not sure what you mean by that. I'll just finish my thought about interest rates.
Yeah.
Interest rates topped out at 20%, and I saw them go to zero. Let's take two off the top, two off the bottom. All right, that's 18 divided by two, right? Or I'm sorry, that's 16 divided by two. That's 8%. That's the mean. So I think interest rates they're going to stay between 3% and 8% for the next 10 years. That's my opinion on interest rates. And people that are doing real estate and doing all the other different things, they have to learn to operate within that framework of interest rates. 0% interest rates are gone, never coming back. I'm trying to keep up with those questions. So
Yeah, a lot of questions, but this is good because that means that you're resonating with a lot of these people, and these people are from all over. And Lewis came down many years ago to Mobile, Alabama, and he had so much fun. Remember that, Lewis? You stayed the whole week, and I think he had nursing homes up in northern Alabama or something. You flew up, and flew back, and I mean,
yeah, when I left,
boy, we had a good time.
Yeah, we had a good time. That's for sure.
But Lewis, I'd like to, at some time in the future, me and you will talk, but I'd like to maybe do something else and we'll do some talking, brainstorming. But I'm sure everybody here really appreciate you taking time. And, I thank you for doing it with no notice. It was like one day's notice. He made a decision to be here. And that means a lot to me and all the people here that follow what we do and stuff. But I appreciate it.
Yeah. Well, so, the one thing I love about these kind of forums is that there are so many smart people out there. I mean, literally, the old saying, Confucius, if you're the smartest person in the room, you're in the wrong room, right? So at the end of
Right.
the day, I feel comfortable here. I'm sure I'm not the smartest person in the room here. I just have a lot of experience that gave me those things, over 22 years. Um, I've seen a lot of different trends, but going back to the market flows, um, that's a key thing. We used to try to see which way markets rotation was going and see what was going to be moving the market. But you got to remember now, you look at the S&P 500 now from when I first started trading. I mean, there are literally 80% of those stocks that were in the S&P 500 back in the back in the 1980s. They're not in there anymore, right? Most of them are all big tech stocks now. So watching that is a thing that is very, very interesting at that point. And I think that this is the whole thing that Trump's trying to bring back, right? He's looking at, we don't make anything anymore, right? We either have tech stocks that, you got Facebook and Instagram, you got Twitter, things like Twitter, ChatGPT, AI, all these different stocks. And I think this is the whole thing that he's looking at, and I think he's trying to correct what's happened over the last 40 years. I'm hoping he's going to be successful. And I think we got a shot at being successful because we're going to be creating jobs. And the thing that's going to help by creating jobs is going to be AI, right? So even though you're going to have job creation, they're going to be aided by AI. So when you look at why jobs went overseas, right? Cheap labor. Well, I think the fact that he's bringing the labor back and that coupled with AI, it will offset the cheap labor, the higher labor costs here. You won't need as many people because you'll be aided by AI, right?
Right.
Michael, love it. Love the tokenization. So let me tell you how I got involved in Bitcoin, right? So I started this company in 2017. I just had found out about Bitcoin, right? And I think it was like Marcus, it was like at $400. I went to a trading thing in um, yeah, too many questions coming at me, guys. Let me finish the Bitcoin story. So what happened was I went to a trading sort of a crypto trading currency uh like the Money Show or something in Las Vegas. And all these, I ran into a bunch of guys that used to be traders. They recognize me. They go, "What do you think of crypto? What do you think of crypto?" And I go, "I don't know what they're calling it. This ain't trading. All I can do is buy and hold." So I'm going, if you can only buy and hold, you can't short it, then, it's really not trading. I mean, you're just buying and holding. So in 2017, in May of 17, I watched Bitcoin go from 1,000 to 2,000. And I go, wow, why did it jumped up? It doubled the price and value in 2 weeks. And then what came out was the WannaCry virus. And the WannaCry virus basically affected 150 countries, and all these people were being ransomware for Bitcoin. That's how you have to pay your ransom in Bitcoin. And so then in October that year, I watched it go from 2,000 to 4,000. What came out? The Equifax breach of what was it? I thought it was like, I don't even remember the number, but the amount of credentials that were breached in the Equifax breach. And then what happened was all those credentials, the hackers were buying the credentials. Now they were literally um, selling the credentials on the dark web, right? And so, and when the hackers got all the credentials, then they start doing the hacking of hospitals, groups, individuals, all these different things, and that's what spiked up the price of Bitcoin in October of 17. And then I wrote an article that says, I don't know where Bitcoin's going, but I know one thing, it's not going away, and it's the leading economic indicator for cybercrime, right? So I had started buying we were buying Bitcoin, so we were having people come to us and said, "Hey, we're a cybersecurity company. We just got ransomware. How do we get out of this?" So then I started negotiating ransoms And then I started paying the ransoms for the companies that were ransomed, and that's how I got into the Bitcoin. But when I wrote that article in 17, I said as soon as the CME comes out with Bitcoin futures, which they did, I said I think the market's going to go to 10,000, and after that, I have no idea where it's going to go. And then it went from 10,000 to 20,000, and then it broke back down to like from 20,000. I think it broke back down to around 10 to 14,000, and then it's been straight up ever since then. And so when I look at what fueled the Bitcoin frenzy was not only the investors, but if you ever, and I don't recommend everybody go there, you'll get down the rabbit hole. You go down the rabbit hole on the dark web, you'll see that everything on the dark web can be bought, and they'll be bought for literally using cryptocurrencies, right? So people wonder, like, how are these hackers getting away with this? Well, they're not here. They're in Russia, they're in China, they're in Iran, they're in North Korea. There could be hackers the next town over, actually using different hops in their the way they sign into VPNs, making it look like they're coming from Russia and so on. So cybersecurity has become an incredibly complicated, and I mean, right now it's a $2 trillion market. So I got lucky again, right? I got in and people started calling me and going, "How'd you know about cybersecurity?" I go, "I didn't know. I met somebody who kind of laid out the story to me, and I said, you know what? That sounds like a good idea." So, sometimes you got to go with your gut and look at the different avenues that are open to you. I got
Well,
like a few
Lewis,
minutes left, right?
yeah. I think that we got most of the questions. I think people understand why I wanted you to speak today, because every time you talk, I learn a lot. People enjoy, uh, I guess, hearing from somebody that's done what you've done, but also your life experiences. Keeping your eyes open, always listening, and then sometimes opportunities knocking on the door if you just don't get biased against one thing or another. Being open minded, I guess, is what I'm trying to say. No, so.
And
Uh,
don't be afraid to take
Guys,
risks.
I'm going to try to talk to him. Maybe we can do something else with him in the future, but I hope everybody enjoyed it. Again, this was totally unscripted. It was totally, uh, non-planned. And you see just how valuable it is when you're talking with somebody who knows what they're talking about. You understand what I'm saying? So that's good. We're going to take a 10-minute break. I'm going to come back and wrap up this class I held today, and then have a meeting tomorrow with the class. But Lewis, again, thank you so much for being here. I know everybody appreciates it, and I'll be talking to you, and maybe we'll get you to Ponte Vedra Beach. See you in person.
Okay.
So,
nice, everybody.
Right.
Good luck. Good luck, everybody. Talk to you
Thank
later.
you.
Bye.
Jonathan, put up a timer for 10 minutes, so I'll come back. We'll wrap up the day and everything else, and I'm going to go get something to eat.